But a key issue we need to ask ourselves is, how are these acquisitions financed? Because this is where many people are surprised. People are like, hey, look at Netflix. Look at their revenue. They don't have any money. 39 billion in revenue. How much profit are they making to be able to finance over 80 billion acquisition? One thing you must understand, and this is how business acquisitions work, it's that when a business, that is the acquiring firm or the predator firm, wants to acquire another company, that is the target firm, after the deal is approved, they're going to find out, okay, how do we want to finance this? And there are various factors that go into determining how the deal is going to be financed. The first thing is to consider the issue in respect of the tax position of the shareholders of the target firm. Basically, let's say we have two companies A and company B. It means the shareholders in company A, they are selling their interest to company B. Now, when they receive that money, there is going to be a capital gains. And so they are going to be required to pay taxes on the gain that they make. Normally, if the shareholders do not have a lot of tax deductions available to write off and reduce their tax burden, then they will be willing to sell, but they will not be willing to do a full cash transaction. Maybe they will be willing to do a share exchange deal, and we'll get into some of this as we proceed in the discussion. So, number one is the tax position of the shareholders of the target company. That will determine whether they will be willing to take cash or not. The second thing is the continuing interest of the shareholders of the target firm. There are some times that the shareholders of the target firm, they see that, oh, this company has a lot of potential. Only that they lack the capacity to provide the necessary funding to help the company to expand and grow in the manner that they want it to expand and grow. And so in that case, they wouldn't want to sell the company, but they are not interested in cash. They would want to get share exchange, which means they will want shares in the parent company. That is the predator firm, the acquirer, their company. They want shares in them. Why? Because they would want a continuing interest in the company. So that is the second thing that we look at. That would determine how the acquisition is going to be financed or will be concluded. So number one, what is our tax position if we should accept this money? Number two, what do we see? Do we have interest in this company? If they don't want to, they don't see anything, they are not interested in the company any longer, then they may want the money. And even if they don't have a good tax position, they may want the money so they can do something else. But the first thing is, what is the tax position? The second thing is continuing interest. That is going to be the second thing that you must understand. Then the third factor that we need to consider. So these two factors are in respect of the shareholders of the target firm, their tax position, their continuing interest or otherwise. Then we now come to the perspective of the predator firm, which is the company doing the acquisition. So from the predator firm, they would also look at a couple of factors that will then indicate what should be the best mix of financing option. The first thing is they will look at the tax implication of the acquisition at the end of the day. So they want to look at, okay, what is the tax implication? If we should go and do this whole acquisition right now, what will be the tax effect? So for instance, let me give you an example in Ghana, and this is in advanced taxation in the ICAG level 3 paper. When company A acquires company B in the same year, okay, within a year, the deal is concluded, and company B is having some carryover of losses. In other words, has some tax incentives yet to be benefited from. The 100% acquisition means, or the change in ownership of more than 50% means that the new owners cannot benefit from the tax implication. They cannot benefit. Why? Because that company's asset has been disposed, has been realized. The assets and liabilities have been realized. And so in such cases, what will happen then is that the company acquiring the other company, that is the target firm, which is having a lot of tax incentive, they will arrange the deal so that the acquisition will spread beyond 3 years. So they wouldn't come in and boom, acquire 100% because of the tax incentive. So the company, the predator firm, will also look at their tax position. In expanding on that, they would also look at any dilution in control if they are supposed to give that. Because, for instance, if the consideration to be transferred is going to be made up of share exchange, that means that the number of shares in issue for the predator firm will be increased. Now, if it is increased, it means that there will be dilution in earnings per share, there will be dilution in ownership. How will the existing shareholders react? So that is a factor that we will also look at. Then, in respect of the tax perspective, it is better to borrow money to finance an acquisition than to use your own money to finance an acquisition. Why? Because the interest on the loan, you can write it off against tax, all other things being equal. Number two, that loan is going to be put on the statement of financial position of the target firm, making the target firm expensive, thereby preventing other bidders, other people to come and acquire the target firm that we just acquired within the shortest possible time. So they look at the tax incentive and say, okay, maybe debt finance will be better, and we are going to borrow the money, put it on the statement of financial position, or what you may call the balance sheet of the target firm, and that way we are preventing other people to come and make a bid, because now the target firm has become very expensive. Then the next thing also is to look at just the financial strength of the predator firm. Some predator companies, the acquirer company will look at its strength. If it has a lot of cash available and the economics does not make sense, in other words, they going to borrow money, the interest they have to pay, as compared to the money they have, if they put it down, what returns they will get on it, then if they realize that, oh, the interest on the loan, although tax deductible, its implication will be higher than they using their own money, then they may use part of their own cash and just borrow a small amount of money. And so these are some of the factors. There are a lot of other things, but on the basic level, these are some of the factors from the perspective of the predator firm and the perspective of the target firm, that is the acquirer and the acquiree firm, that goes into how the deal is going to be financed.